All right, good morning, everybody. We are in week 14 here, and we're going to talk about chapter 18, which is the final chapter of the course. And so, obviously, we're week 14, which began 12:1, but I sort of deferred some of the activities previous to this, and so we're going to cover the final chapter, chapter 18, dealing with issues and items concerning shareholders' equity. And we're going to start that today. Hopefully, get through this today through Thursday, and I've also got a supplementary video for chapter 13 that you'll see probably later today once I get it posted. And there's not much left on that, but as I've said before, intermediate accounting is a very dense course. As long as I've been involved with intermediate accounting, there's a lot to do, and there's a lot of things to cover. And unfortunately, sometimes class time doesn't cover it. So this is why I sort of make myself available to you if you have questions. And so as a result, so week 14, so we've got some things to do here. Shareholders' equity is the chapter we're going to be getting today, and I'll cover more on Thursday as well. And hopefully I'll get through the rest of it on Thursday in the normal class time. But if not, I'll do another supplementary video. It's not a problem. So the quiz and homework, I pushed back to Sunday. I know that typically the sort of the cadence of due dates is Friday, Sunday. It's Friday quiz, Sunday homework, and I pushed that back to the 7th, which is Sunday. And we also have the exam covering chapters 10, 11, 13, and 18. And so that's the third exam. And then next week, really the only major activity we have is the final exam itself, and that's going to be due by the 12th, which is going to be, I think, a Friday, right? So we're going to talk more about that next week. If you have questions, I'll be here, and and most of next week is really going to sort of be dedicated to answering any questions you've got about any kind of content items and whatnot. So. And we'll talk a bit more about that as we get deeper into this particular part of the course. But this is sort of where we are right now, is the idea that we're sort of toward the end, and that's kind of good news. So, and I've not reviewed your ethics cases yet, but I'll do that. I'll probably get to that this week, I'm sure, and review those. And so, if you have any questions about that and any other questions, feel free to reach out. So that's where we are. So we're in the very last stages. And we're going to talk about shareholders' equity. And remember, let's just kind of zoom out here and talk about what the logic and the organization of this course is. I've long said that intermediate accounting is essentially a walk around the financial statements, and that's what we're doing. And so we've covered the asset side of the balance sheet, and we've moved over to the right side, the quote unquote right side, talk about liabilities, current liabilities, long-term liabilities. And now we're going to talk about shareholders' equity and all the pieces that go into that whole puzzle of shareholders' equity, what that is. It's kind of residual, really. It's the residual interest in assets that belong to owners. And whether or not, you're a sole proprietorship, partnership, corporation, whatever, this is the ownership in assets that is residual. And it's manifested in a lot of different ways, both paid-in capital in terms of investors, owners/investors, putting money into the company, as well as earned capital. As the idea of the company earns money and they recapitalize some of those earnings into the business itself. And that is, they don't distribute them in the form of dividends. They're not taxed away, not dividended away, or whatever the case might be. So those are really the two broad categories that we're going to talk about. And then we're going to sort of drill down deeper into the certain dynamics of the individual items that we cover in a balance sheet and a report on a routine basis. So let's get at it. So any questions before we get started here? Let me see here. Something in the chat box. Question about the exam 3 and then Excel spreadsheet. Okay, in terms of where you get feedback, I'll do my best to get feedback back to you before the final exam. I'm not sure how useful the feedback is going to be, but I'll try to do my best to get that to you. The final exam itself is going to be comprehensive, so I don't know that it's going to be ultra useful to you, but I'll do my best given the fact that we have certain time constrictions and whatnot. But we'll do the best we can. I know that in the Connect website, I know sometimes people have had some questions about whether or not we can get the feedback and whatnot. And so sometimes it comes back, where students have questions about it. We do tend to reuse the exams and whatnot, so we don't really want to provide all the answers because we don't want to get them out on the street to future students and whatnot. So I think that's something that I think you have to sort of understand, that we just cannot give you all the answers back and say, here it is, and we're going to roll this out in the spring semester and whatnot. So it just doesn't quite work that way. So, all right, so let's get into, all right, so this is the plan, 12/7. I changed the due date. Originally it was set for 11:30, and I pushed it back to 12/7. And then next week, the final exam, which is, we're in the final stages here. It's comprehensive. It goes back to all the way to the beginning. And it's going to be due on Friday, 11 p.m. So, and we'll talk a bit more about that as we sort of approach that. So, all right, so let's talk about shareholders' equity and what's going on with this. So remember, I said earlier at the outset, this is sort of residual value that sort of takes total assets minus all liabilities, and you end up with this idea of shareholders' equity. Okay, and obviously, as your text notes, that sole proprietorship, it's simply capital. It's a capital account, one capital account, nothing difficult. In a partnership, there's individual partners. And by the way, partnerships, they're sort of almost a dying breed, I think, in a lot of ways. I can't really think about why anyone would want to start a partnership today. And I know that back in the day, partnerships were very common. Law firms, accounting firms, maybe some other professional firms, engineering and whatnot. I can't think about why anyone would want that in a lot of ways. But the point is that whatever interest that owners have in the assets is reflected here as a residual value of the idea of assets equals liabilities plus shareholders' equity. So in other words, if you sort of reverse the equation, assets minus liabilities equals shareholders' equity. But I want to sort of drill down. This is an interesting slide here. I don't know that I've seen this in a lot of places before, but you get this idea of external financing, and the idea that there are external parties financing the business itself. And so when you've got debt and equity, what are we really talking about? We've got creditors interest, what we call creditors' equity. Now remember, the entire right side of the balance sheet, has, and I think it's maybe an old school term, but it's what we call equities. And so, in other words, the more basic accounting equation is assets equals equities, in which we've sort of refined to be on the right side, assets equals liabilities plus shareholders' equity, right? For a corporation, obviously. Now, corporations are noted by shareholders. But in this case, what you've got going on here is you've got the idea of external financing sort of broken out in terms of the interest in assets by the creditors and also owners, which is fine because that's really what equities are all about, the interest in assets. And so assets minus liabilities equals shareholders' equity. So you've got two different entities involved here, creditors collectively and owners collectively, right? And this is not one party generally. These are often multiple parties that have an interest in assets. Now, whether that interest involves a collateral interest where they can sort of move in and seize assets or whatnot, which we sort of think about in terms of creditors' interest, is really mostly irrelevant. It's the idea that if you're the business, and let's take it from the business point of view here, which remember we always have to sort of shift our view to who are we here? We're the business, right? And we owe somebody money, then they inherently have a claim on our assets. It may not be easy to get to and whatnot, and maybe these assets may not be specifically pledged as collateral and whatnot, but particularly in trade relationships. But nonetheless, there is interest in assets on the part of creditors, and so we simply call that creditors' equity or creditors' interest. Interest and equity are really sort of the same idea here. Okay, we tend to think of equity as being an ownership interest, but it could also be any other kind of interest as well that we really want to talk about. Okay. Okay, so the term net assets is often used as a sort of a synonym for owner's equity. That is, it's presented as an asset side figure, and sometimes you may see this. You may see this in other countries where the term net assets is really this idea of the residual of owner's equity. And we talk about external financing in general. We're talking about external financing is that which is invested or loaned. And by the way, a trade payable on the part of a company, it really represents an amount that's extended to that company for whatever it is, inventory, services, goods or services that are provided on a very short-term basis without interest, I might add, usually, typically. If it's very short-term, like up to, say, 90 days, there's probably not interest involved. And so it's a form of external financing. And this is why a lot of companies want to stretch out their payables as long as they can. Obviously, the receivable holder on the other end probably doesn't like that very much, but you get the idea. Sometimes these things happen. So this is what we call internal financing, and so let's talk about this idea of external financing. And we're sort of jumping ahead here a bit, maybe, but I think it's important for us to understand when we talk about external financing, it's that which is investor loaned, which is independent of financing from retained earnings. That is internal financing. That is internal funding or financing. The terms both come up, and a company can earn their capital through earnings. And a lot of companies simply have grown earnings over time and simply have reinvested them again and again and again. Now, there's some tax issues involved with that, so I don't want to sort of get into it here, but that is an issue where companies can simply not rely upon external financing, that is creditors or even outside investors, to fund their business. In some ways, it's probably a good way to operate because the more cooks in the kitchen, sometimes the more confusing the situation. So we talk about the nature of shareholders' equity. We're talking about ownership interest. And again, I mentioned this a second ago, and I don't want to spend too much time on this, but we've really got two broad categories: paid-in capital, which really represents initial, supply of capital, financial capital. We're talking about money invested in the business, and it could be over and above the initial, what we call par value, and we're going to get to that in a second. And there's also retained earnings, and so this is really sort of external financing, right? So we talk about external versus internal. This is external paid-in capital, and when we say external, let's be clear, because a lot of our focus in intermediate accounting is on publicly traded corporations where the owners are unrelated and have no connection whatsoever to the management of the company and whatnot. They're simply passive investors, and they pay in money to the business. And we'll talk about this idea of the initial startup, capital, as well as the idea that the companies will buy back stock, reissue stock, and all that, and we'll have a way to account for that through what we call additional paid-in capital, which is a premium over that. But this is external financing. And we need to be clear when we talk about external financing, we're talking about owners who really are independent of the company itself. These are individual investors, they're corporations, they're investment firms, and increasingly today, we're seeing a lot of the equity of companies, when we say equity securities, being purchased by private equity type organizations, private equity being sort of an umbrella for hedge funds and other kinds of elements like that. So there's paid-in capital. There's also retained earnings, which is sort of internal financing. There's their internal generation of equity. Okay, but all these sort of fold into shareholders' equity. And then what's really maddening, and this is something that I've been on sort of a crusade for a long time, to sort of standardize these terms that we use, because we're not really standardized in a lot of ways. It'd be very nice if we can all agree on one particular term. I don't know why we have all these different terms: shareholders' investment, stockholders' equity, shareholders' equity. They're all the same thing. They're all the exact same thing. Shareholders' equity, that's the residual of assets minus liabilities. All these are different terms. It would be very nice if we standardize these at one point. Maybe we will at some point. But for right now, we've got this sort of sort of scattershot view of what this is. But they are the same thing. Mathematically, they're all the same thing. So there's really no difference there. It's just the fact that we've got different sorts of terms for them. So, all right, so we talk about shareholders' equity, we talk about paid-in capital, retained earnings, and we're going to get into treasury stock. I don't think we're going to get there today. Probably on Thursday, we'll talk more about treasury stock. Treasury stock is simply repurchase shares. And by the way, these share repurchases have been a big in the last several years. We've seen lots of companies buy back stock. And there's a reason why they do it, and we'll talk about it. In some cases, it gets very controversial. Politicians get involved sometimes. They don't really like the repurchase of shares. And we'll talk about what's going on there. And we'll talk about accumulated other comprehensive income. So this is a balance sheet item that goes under shareholders' equity. So let's go back and sort of rewind a little bit. And first of all, let's talk about other comprehensive income. other comprehensive income is really an income statement item that really captures the sort of outside activities of a business that really don't relate to the activities of the business themselves itself, but rather does impact net income. These are things like changes in pension valuation, changes in currency translation. Currency translation is simply the broad term for the fact that companies do business overseas. They sell in euros and in yen, and they've got to translate them back to US dollars. And currencies themselves are commodities in their own right. So sometimes you have to translate them back to US dollars. Well, if you're going to report in the US, you're going to translate them back to US dollars. And there's what we call CTA, currency translation adjustment. Those are big ones there. But those are income statement items, and they work their way into accumulation in the balance sheet. Now, remember the balance sheet, let's just kind of zoom back out here as to what the balance sheet is. The balance sheet is this snapshot picture as of a certain date, December 31st of whatever, or whatever the year end is. And I don't mean to assume that all companies have December 31st year, because they don't. But let's just simply say, okay, we're going to take the picture right now, boom, and we're going to translate our earnings and holdings of foreign currencies into a different into US dollars. Okay, and if you're reporting other currencies, you're going to translate those into other currencies as well. And this is a bit maybe beyond intermediate accounting, where we sort of get into advanced accounting in this direction. My wife used to do this a lot when she worked for Dow Chemical, translating all these foreign earnings, back in, and this is before the euro even. I know I'm kind of an older guy here, but we had to translate from German marks and Italian lira and all that back in US dollars and whatnot. And that's pretty much what she did for a living. And so as a result, that's an example of what other accumulated other comprehensive income is. But in the balance sheet context, which is what we're really talking about here, we're talking about the fact that we're accumulating these differences over time, and it adds up to shareholders' equity, positive or negative, whatever the case might be. And this is why currency stability is important. And when currencies are not stable, then it leads to a lot of consternation and a lot of, frankly, earnings issues as well. So, all right. So when we talk about a balance sheet, and this is kind of small, I'm trying to blow it up a little bit here if I can. So this is an example of the Exposition Corporation, December 31st, 2021 balance sheet. These are the examples of the items that would go into shareholders' equity. You got paid-in capital. So remember, you got two different categories: paid-in capital, and you got retained earnings, right? Retained earnings, simply one line item here, right? 1.67 million, or I'm sorry, 1.67 billion. These are represented in millions. And you got capital stock, you got common stock, and you got paid-in capital, all these things. We're going to talk about this paid-in capital and what this is, because companies do not issue typically one class of stock. I mean, some do. I don't mean to suggest that none of them do, but a lot of them have additional shares of stock for all kinds of different purposes. And these are equity issues, okay? And then they're brought to market, and they represent really the capitalization of the company. When we talk about capitalization, we're talking about, all right, we would debit an asset, we would credit the shareholders' equity if we're issuing stock, net of all the fees that are involved, and we'll sort of get to an example on this as well. So paid-in capital is outside financing from external investors. Now, I say that, and I realize, and I know that this is, I don't mean to muddy the waters here, but sometimes internal buyers, that is, insiders, company shareholders, or company owners can invest as well and own quite a lot of shares. And sometimes they're granted to the company itself and or to the owners themselves. And so as a result, paid-in capital, may involve insiders, but primarily it's this issue of any investor. This is why we call them public companies. Anybody can invest in these shares, right? And that represents total paid-in capital. Retained earnings, though, are these accumulation of earnings over time. And then we have this final sort of odd issue of AOCI, which is gain or loss from available for sale investments. We're going to talk about that in a second. Let's hold on to that. Pensions, we're going to talk about that. Actually, we're going to talk, I think, more in Intermediate 2. I don't teach Intermediate 2, but I think that we talk about that there. Deferred gain or loss in derivatives, we'll talk a bit about that. I do know something about that. And then the foreign currency translation. And in my mind, we talk about AOCI, which is simply the accumulation of all the activity that results in OCI on the income statement. which translates back to the balance sheet. The two big categories really are pension valuation issues and currency translation adjustments. Here we've got zero, which I guess it's kind of nice if you have no foreign currency, but that's really not the case in typical. So, we'll talk about this idea of available for sale. Some of this is going to be covered again in principles, I'm sorry, in intermediate two. So, if you're wanting more on this, it's going to be coming up. And then the final thing here is treasury stock. And we'll talk more a bit about this. Treasury stock is really sort of a negative. It's really sort of a contra equity situation where the company's buying back stock. We'll talk about why companies do that. Again, we're not going to get to that today. Hopefully Thursday we'll have some time to talk about what treasury stock transactions are. They're simply share repurchases that a company will do, and companies do them for a lot of different reasons, and we're going to get to that. So let's sort of defer that discussion for a bit. So, all right, so let's talk about shareholders' equity. So these are all the same facts that we covered here. I believe it refers back. Yeah, it refers back to this here. But we're sort of breaking that. We have preferred stock. And again, preferred stock, we'll talk a bit more about preferred versus common here in a second. And we'll talk about what that is. Preferred stock is simply a different class of stock, non-voting typically, sometimes convertible to common stock, sometimes not convertible, sometimes cumulative, sometimes not cumulative, sometimes participating, sometimes not participating. All these terms are sort of covered in your text. I will talk about these as we get going a little bit. Preferred stock is sort of a hybrid between equity and debt. And it's sort of this bridge sort of finance. Well, that's probably not the right word. It's a sort of intermediate hybrid is probably the best word for it, right? That's the term I've heard for a lot of years, between debt and equity. And it's interesting, and it's interesting also to sort of switch the sides here and look at why investors would want preferred stock. And there are a lot of advantages to it, so we'll talk about that. Common stock issued at $1 par. We'll talk about par in a second, what that is. It's mostly arbitrary. Additional paid in capital, that's any kind of amount paid over and above the par value, and we'll talk about that. Whether it's the original issue or whether it's subsequent buybacks, and retained earnings, 1.67 billion retained earnings. This is, again, retained earnings simply, it's like a corporate savings account where the company, these are funds that have never been paid out in dividends or taxes or whatever, or expenses. And so as a result, we've accumulated them. In other words, we've capitalized these earnings over time. So retained earnings are an important piece of this that is earned capital as opposed to invested capital. Okay, that is internal funding versus external funding. And accumulate other comprehensive income. It's a long term is gain or loss from available for sale investments. We'll get to that. We'll talk a bit about that. Well, actually, we're going to talk more about this in principle in intermediate two, I believe, particularly because when we say available for sale versus what? Well, versus those which are to be held for long term. And so we'll talk about that because I would assume a lot of people here who are taking intermediate one are going to be sort of taking intermediate two shortly. And so you'll talk a bit more about that. Unrealized loss on pensions. This is a big issue. I mean, the pension issue and pension assets are something that are an important topic. And it's really a very specialized area. I will admit that I am not an expert on pensions. And we get into some actuarial issues here in terms of life expectancy and whatnot. And so pension accounting really, the CPA world has sort of delegated this to the actuarial profession because of the issue of life expectancy and who's to receive pensions and whatnot and investment returns. And so it's a fairly complicated issue. We're not going to talk that much about it in this course. We'll talk a bit more, I think, in principle, in intermediate, keep saying principles, intermediate two, and you'll go from there. And deferred loss on derivatives. Derivatives are simply these instruments that companies use, often for hedging purposes. We'll talk a bit about that here before we leave today. And then treasury stock are simply buybacks, which are contra equity accounts, right? We're buying back stock, so we're reducing the equity of the company. In other words, we debit cash typically. I'm sorry, credit cash, and we debit equity. So the debit is to shareholders' equity, treasury stock. Credit is to cash. We're buying shares back. So $6 million of shares bought back, and so we end up with total shareholders' equity this is sort of the line item breakdown of an example of what a shareholders equity reporting might look like. Okay. All right. So let's kind of get into it, talking about the components of shareholders equity. We're talking about paid-in capital. We're talking about that which is invested by shareholders when they buy shares or from companies buying backs of those shares. And this is where it gets a little bit complicated, and it gets a bit complicated for historically ridiculous reasons, I think, in terms of par value, and we're going to get to that as well. But companies do buy shares back. And we've seen lots and lots of share buybacks in the last, I don't know, 10, 15 years and whatnot, mostly because companies have been doing very well. The economy has actually been really, really strong. And so companies are earning a lot of money, and sometimes they reward shareholders, not by dividends, that is distributions on a periodic basis, but by shareholder buyback or by company buybacks of shares. In other words, reducing the number of shares out there, and the company's earnings it has nothing to do with the company's earnings power. The company is still earning the same amount, but it kind of boosts all the financial performance ratios, and so companies buy back stock all the time. And that may change if we, as people say, we may be heading into recession. Who knows? I don't know that we're going to get there, but you get the idea. But there's a lot of buybacks that have been happening. So, and also from share-based compensation activities, sometimes companies will buy back shares in order to give them to employees. And in the past, certainly in my days, management, they got these share-based compensations. But today it's a little bit more egalitarian. It's more democratic. It's been spread out to more employees and whatnot. I know that I used to get stock options. That was the option to buy stock back. And today, share-based compensation, which, by the way, we could do an entire semester on this particular subject. There are all kinds of issues with regard to what we call deferred compensation and whatnot. So let's not get into that here. What I do want to talk about is the idea of paid-in capital is one category, retained earnings is another category. This is outside earnings, net of the idea of buying back shares. Okay, so and the retained earnings are simply this sort of corporate savings account. And then treasury stock is stock that's out there currently in the market. It's what we call in the float, right? And there's a difference between the amount of shares authorized and the amount of shares out there floating around, because sometimes insiders cannot sell shares. They're, in other words, in a lockout period, a lockup period, and they can't sell shares. But for the most part, though, the shares out there are what we call the float, and sometimes companies will buy those shares back. And we're going to talk a bit about what that is. And on Thursday, I'll give you some data as to sort of what the trend has been in this, because I think it's an important issue, particularly for those of you who are going to go into work in public accounting, for a big company and whatnot. Stock buybacks are an increasingly common phenomenon, and we'll talk about why that's the case. And there are some tax issues involved as well as to why companies would do it, and that's something that's a little bit beyond what we're doing. I do cover it a little bit in my 2350 corporate tax course, but here we're not going to cover that all that in depth. All right, so the components of paid-in capital. Quick question: which of the following is not a component of paid-in capital? A, amounts invested by shareholders when they purchase shares of stock. That sounds kind of right. Earnings accumulated on behalf of the shareholders. C, amounts arising from share-based compensation activities. D, amounts arising from share repurchases. So what is the answer here to this particular quiz question? Where's my cursor? There's my cursor. It's going to be B. That's why I sort of thought that didn't sound right. So earnings accumulated on behalf of the shareholders. That would be retained earnings. In other words, earned capital as opposed to invested capital. And I wish the text would have sort of broken this out into this sort of activity based categorization, where paid-in capital is really invested capital, and retained earnings is earned capital, because some textbooks use that, some do not. Again, it would be nice if we had standardization in all of this, but the idea is the fact that if you've got earnings that are accumulated, it's retained earnings, and it's like a corporate savings account, and companies can use that for all kinds of different purposes, expansion or whatever they want to do with it, right? And that's up to management. Okay. All right. So questions about any of this so far? Let me see here. Let me go in the Zoom call here. Let's see. Any questions? Anybody in the house, in the room? Okay. All right. Okay. Let's let's talk about the next issue here, which we're talking about shareholders' equity. And that is the idea, what are the components? And let's talk about AOCI, okay? So it extends the view of income beyond net income reported in an income statement. So there are really four main categories here of AOCI. And again, we're going to talk about some of the differences in recognition of these items versus the international standards. And we're going to get to that here shortly. But what we're really talking about, and we sort of covered this, so it's a book review, that is gains or losses on what we call AFS, or available for sale investment securities. These are securities that a company can hold on a short-term basis, and they are only buying and selling these for short-term purposes. And a lot of companies will do this. A lot of individuals will do this. That's the idea that you don't want to have a long-term investment in something. You're going to sort of buy something because you need to use your cash somehow. Corporate treasurers are usually the ones that are tasked with this idea of investing money on a very short-term basis, right? And they can earn gains, they can earn losses, and as a result, but this is but it will affect the income statement, obviously, as an OCI matter, but it doesn't really reflect the overall activities of what the company is doing, right? So my next door neighbor was an insurance executive, was a treasurer of an insurance company, and he invested in a lot of securities, treasury bills, and treasury notes and whatnot. But that wasn't what the company is involved in doing. They're involved in selling insurance, mostly to farmers, and as a result, any kind of. And I knew the guy fairly well, and we talked about this idea that some of these were outside the normal activity of what the company was doing. So which means on the income statement we drop it down fairly low on the income statement, right? And on the balance sheet we put it as AOCI. So OCI is the income statement recognition of the gain or loss, whatever the case might be. And we accumulate these, which on the balance sheet, remember, the balance sheet sort of accumulates all activity over time from day one in the entire existence of the firm. And so as a result, we have a net amount that's reported in AOCI, okay? Also, we have gains or losses from retirement plans. Again, I don't want to talk a lot about this. And I will admit, I am not an expert in this area. I just, there are things that I know about accounting, and I've been around it for a while, but this is the area that I am not very confident about. But we do talk more in intermediate two about this idea of benefit plan adjustments. Idea that FASB has sort of been trying to redefine how we do the accounting for this. And I know there's been lots and lots of discussion in the corporate world and about how we do accounting for pension valuation, because it does impact the balance sheet, right? But this is an area that's something just to kind of know about, okay? Just kind of know that the pension valuations may differ, and why it's difficult. It's not the fact of the assets that are held being up or down. It's more about the idea of retirement obligations and how long people are going to be living, and that's a big question, right? I know that my predecessor here, her father-in-law, I think, retired at age 43, I believe, and lived to, I think, 102. So he was drawing pension benefits for almost 60 years. And so, this is people living longer. And so this is an issue where benefit plan calculations become a little bit trickier. Okay. All right. So, but we'll defer that to intermediate two. Also, deferred gains or losses on derivatives. So let's talk about derivatives. I did have some involvement with this. I was a trader for a while, and so did some investing in derivatives. What companies do typically, you can sort of divide these activities in terms of speculation or hedging or and whatnot. So companies will a lot of times lock in prices of certain, usually inputs, material inputs, whatever the case might be, jet fuel, grains, raw materials, whatever the case might be. And sometimes they gain value, sometimes they lose value, and sometimes they are involved in purely speculative activities where they're simply investing money into derivatives. And derivatives are simply this idea of it's a financial asset that is representative of some underlying asset itself. And sometimes there are gains and losses on this. I come out of the financial world. I never worked in manufacturing. And I know that we had a lot of gains mostly gains, which is good, as opposed to losses on things like interest rate swaps and whatnot. And so as a result, sometimes we would book these. These are not what we're in the business of doing, but we did them because we had excess cash and we need to do something with them. And so as a result, deferred gains or losses, whatever the case might be, gets calculated and added to the balance of AOCI. And then also the big one that I talked about. I think it really is a big one for a lot of companies because remember, when we talk about intermediate accounting, we're really not talking about small businesses. And I know that sometimes our students take, principles 1 and principles 2, and they think we're really talking about small businesses. And even though we talk about the fact that there's corporation stock, that there's common stock, preferred stock, whatnot, which does not suggest a small business that is a plumbing contractor in, where North Valley of Albuquerque or whatever. We're talking about a big company that's got exposure internationally. And if they have exposure internationally, they're going to have exposure to currency and currency translation. And the translation is simply the idea of taking whatever the value is of the dollar versus the peso, the dollar versus the euro versus the yen, whatever the case might be. And there's going to be gain or losses that result from that. And it's simply a risk of doing business because we have multiple currencies around the world. And so as a result, that's what goes into AOCI. And so that's a big, big, big factor of that. And so when I think of the components of AOCI, I think about two things here. I think about benefits changes, and number 2, and then number 4, foreign currency translation. Those are big, big, big ones. And when currencies are fluctuating around the world, it becomes a difficult story. And right now we're seeing some currencies that are, the Argentine currency has been under pressure, the Argentine peso, and the federal government, our federal government's been trying to step in and try to deal with that. Whether it's successful or not, who knows? But there have been successes in that particular area. And in macroeconomics, the instructors will probably talk more about that. But you get the idea. From a business point of view, these are adjustments that need to be made to AOCI, which is a component of shareholders' equity. Okay, so let's kind of zoom back out here, and I think it's really interesting that we sort of present it this way. So we talk about AOCI because remember what we're doing here in Chapter 18 and really the last several weeks is we're sort of working our way through the balance sheet. But the balance sheet and the income statement work together. It's what we call articulation. And so as a result, what we got, OCI, which is sort of goes down to the bottom on a periodic reporting of income, i.e. an income statement, it makes its way over as whatever the net amount is, works its way over into shareholders' equity as a component of what we call AOCI, right? We talk a bit about that in Principles 1, not very much, but here we're going to try to drill down a little bit more into that, where we're talking about the idea of what happened during the accounting period, the year, the quarter, whatever the case might be. So we have net income, which is income that is presumably after tax, I would imagine. That's all operating activities, all non-operating activities. And so we have a net income figure, probably after tax. And then we have these odd things that we call comprehensive income, which are typically on a statement of comprehensive income. Now, sometimes companies will report this as a sort of an add-on to the income statement, but typically what we're seeing, I think more commonly, is a separate statement called the statement of comprehensive income, which sort of reconciles the net income of the company, that is all the activities of the company during that period, with all these odd things. When I say odd things, I don't mean to sort of denigrate what they are, but they're not really the main core of what the company's about. You're a company that makes shoes, right? You're not really making pension gains or losses. You're not really into trading in currencies to make gains or losses, right? You're making shoes. And so as a result, these are things that are outside of the normal operating activities of the company. And so we sort of separate these out. Whether it's an addendum to the income statement or what is more common is a statement of comprehensive income, or you sort of break these 1, 2, 3, 4 items out, right? And you have some dollar figure. These are all X's here because who knows what they are, positive, negative, whatever the case might be. And we have comprehensive income, which is added to or subtracted, whatever it is, positive, I guess it's positive in this case, which is added to AOCI on the statement of shareholders' equity. In other words, it goes into the balance sheet itself. This is a way that we sort of separate these things out because remember, what accounting is, at the end of the day, accounting is about organizational logic. That's really all it is. Obviously, there are a lot of details and maybe not everybody likes accounting. I know that for a fact that everyone likes accounting. But those of us who do like accounting like the idea of the organization and logic, and there are rules, and we apply the rules, and everything sort of works out, right? And yes, there are odd situations that come up, but for the most part, the rules are there to sort of guide us as guideposts as to where we're going to go. Okay. All right, so here's an example. We have Abercrombie& Fitch, a real-life company. Obviously, companies keep track of individual APIC accounts. By the way, APIC stands for Additional Paid In Capital in company records, but they report these amounts as a single subtotal called Additional Paid In Capital. Now, by the way, let me say a couple of things here, because we're going to sort of backing out here into Additional Paid In Capital. Remember, we're talking about two different categories of invested capital. That is invested capital. Well, no. Two different categories of shareholders' equity: invested capital and earned capital. Then we have AOCI, which is kind of this accumulation of other sort of sort of tangential activities. When we talk about this idea of paid-in capital, we also have this idea of additional paid-in capital that we call APIC. And so we're going to talk about some examples here of what this is. And so in this case, Abercrombie & Fitch did what? They issued common stock, right? And they have paid-in capital, and they also have what we call additional paid-in capital. Additional paid-in capital is simply the premium over whatever the par amount is, if it's a new issue, or even if it's a stock buyback or whatnot. And I really, really wish that we never had par value. I think it confuses accounting students. It confused me for a lot of years, and it's really sort of I don't know. It's something that's been around for a long time. It does sort of confuse the issue. So, but companies do keep track of what's going on here, and as a result, so you've got a company that issues common stock, and there's what we call additional paid-in capital. Well, we'll get some examples here. This is sort of a weird placement, in my opinion, as to what's going on here, but we'll talk about more in terms of some examples. This is a cutaway of the balance sheet for Walmart. And by the way, sometimes these statements that you look at on annual reports, what we call 10Ks or even 10Qs with the quarterly reports, sometimes the balance sheets themselves are very, very sketchy. They're not wrong. They're not misleading. It's just that they're very condensed. And so for users, the issue is, how do we drill down into these statements in order to uncover what is actually going on? Because this may be really one line item here, right, on the balance sheet itself, right? And so as a result, what do we got? Or a couple line items. You got common stock, you got capital in excess of par value, what we call APIC, retained earnings, AOCI, and then total equity, which is sort of the accumulation as we go sort of horizontally and then vertically to this figure here, which is $77 billion as of, I don't know, 2014. Or I guess 2016. Unless we have 3 different years going on here. Okay, yeah, that's right. So, but the key thing is we're sort of adding these things up horizontally, and we're going to get these figures here, right? This would not be one statement. This is sort of a presentation of equity, and it changes over time. And so as a result, we have this amount of equity there, right? So, and again, your text maybe gives a little bit more context to this particular discussion here. But what we want to talk about is this idea of how we sort of break down the components of shareholders' equity. So a quick question here: components of other comprehensive income. Which of the following items would not be reported in the statement of comprehensive income as OCI? So remember, because we're talking about the balance sheet here, we really cannot ignore the fact that the income statement exists, because it sort of informs the population of the balance sheet. So what are the items here? A, decrease in the value available for debt securities. Well, that sounds like that might be right. B, loss on post-retirement plan assets. That sounds right. C, gain on sale of equipment. D, adjustment for foreign currency translation. Well, the answer here, I think, is pretty obvious, and that's going to be C. C, gain on sale of equipment, because that's a little bit more related to the business itself. OCIs are simply things that happen that are part of the doing business, but they're really not the core activity. And I know that when we talk about this idea of trading in derivatives and whatnot, you may say, well, wait a minute, there are a lot of companies out there that do trade in derivatives. Well, that's true. If they are, then it becomes part of their core activity. It does not become part of OCI necessarily. But unless it is not part of their core activity. And so that's essentially what we are sort of defining. And some of this gets us a little bit off into the range of maybe the next sort of advanced accounting as to what exactly constitutes core activities of the business itself. And by the way, to make matters more complicated, we have differences in international reporting standards versus GAAP, which is US, which are US standards. And so we talk about this idea of reserves. And so remember, when we talk about capital stock, we're going to get into this a bit more here in a second. We have common stock, preferred stock, and we have paid in capital in excess of par. Okay, we'll talk about what that is. That's par is sort of a nominal value that's assigned at the time of issue. It would be nice if it didn't exist at all, but it does. Paid in capital in excess of par for preferred shares. This is a little bit more relevant, though, in this regard. Under the international standards, we have ordinary shares and preference shares. Not that different, really. Share premium and share premium on both of those. So there's not much difference there. There are some differences in terminology that we see, but nothing, major. Again, some of the major issues in the GAAP versus IFRS comparison is asset valuation, equity valuation, not terribly different. However, we get an AOCI, we have net gains or losses, foreign currency, and all this and all that. And we have an investment revaluation reserve. So it's a different terminology, but it's essentially the same thing. A translation reserve, a revaluation reserve, and the retained earnings are essentially the same. This reserve on the international side is simply this idea that it's simply a relabeling, it's a renaming. There's really not that much difference. And for those who think that there's wild differences between GAAP and international standards, not so much, and this is one example where it's not that different. Here we have shareholders' equity presented after liabilities. This is statement presentation, whereas equity is often presented before liabilities. If you've ever seen statements that are presented from, say, French companies, Italian companies, whatever, it's a different order, and it's a little bit unsettling to those of us who've sort of expected to see certain things on a balance sheet. It's a little bit different, but they're the same. The numbers are all the same. It's just the order of things is a little bit different. And again, there's really no progress that doesn't seem like in terms of reconciling the differences between GAAP and international standards. But in terms of balance sheet ordering, I don't know that this is the biggest scandal of the year. I think it's something that we just kind of have to sort of deal with. Okay. All right, so let's talk about this idea of GAAP versus IFRS. Which of the following equally related items is used under IFRS but not under US GAAP? Okay, well, and obviously the answer has got to be D, revaluation reserve, because that's the only element of this which is going to be different than what we talked about before. Okay, so revaluation reserve, and it's just simply another way of renaming what we already know to be the case. Okay, all right, so any questions about that? Okay, so we got about 25 minutes, and we're going to talk we're going to sort of drill down into the accounts that constitute shareholders' equity. And so we're going to start with a sort of a explanatory, more qualitative discussion here about the corporate organization and why a company would want to be a corporation in the first place. And so hopefully this is not new information to a lot of people who've had business courses before, or particularly including Principles 1. Where what are some of the advantages? One of the big ones is limited liability of owners. That is, owners do not have liabilities for the company's debts. Their liabilities is limited to the amount they've invested in the company. If you go to zero, that's fine. Well, maybe it's not fine, but it doesn't mean that they have unlimited liability. And there are cases in which investors have had unlimited liability. And we saw a case where Lloyd's of London, which was an insurance exchange, had a number of owners who had unlimited liability. That is, whatever kind of losses were being incurred by insurers, particularly for things like property and casualty, things like storms and hurricanes and whatever, they had unlimited liability. A lot of them got wiped out. I'm laughing, but it's kind of old school to have the idea of unlimited liability, because the idea is we want to limit the liability of owners to their individual investment itself. And so that's the great advantage of that. There's a corporate identity that the company has that assumes and is a shield to individual owners. And that's what really encourages owners to invest. If I invested in Ford, as an investor, and Ford was creating defective products, and it affected my own personal net worth, maybe I don't want to invest in Ford, right? Or Boeing, or whatever. I mean, I'm not picking on Ford, whatever the company is. So it's limited the amount that is invested in it. So limited liability is a big one. In Britain, we something call these limited companies, which is the same thing essentially as what our corporations here. Ease of raising capital. Companies have all kinds of different ways to raise capital. We've talked a bit about this, both the short and long term. And it really, the bigger the company is, and you get bigger, obviously, by generating earnings, but also by raising capital from owners, from investors. You have all kinds of different mechanisms by which to raise capital. And today, really and truly, the financial markets are sort of swimming in capital. That has not always been the case, but companies can usually raise capital from all kinds of different sources that are out there. On a short-term basis from commercial paper, on a long-term basis from things like investments by private equity companies, or companies that invest in startups and whatnot. This kind of thing. So there's a lot of capital out there. So it's easier. And if you're a sole proprietorship or a partnership, that is really not available, because those advantages do not accrue to those particular investors who are looking to invest money in these particular kinds of activities. Okay, so there's a lot of advantages, and there are a lot of legal advantages. Some of the disadvantages are extensive reporting requirements. Yes, you're going to deal with accountants like me, right? You're going to do, and we're talking primarily about what we call C corporations. That is, companies that are bigger than what we call S corps, which are essentially proprietorships or partnerships that have adopted a corporate form for a lot of good reasons, and we talk a lot about that in tax too. But we're talking about C corps are those companies that issue stock to whoever wants to buy them, and but there's a lot of reporting requirements. And by the way, a corporation is going to file a separate tax return. It's got to do a lot of reporting requirements, and also I think it should be mentioned, this is a little bit outside of our bailiwick here, we're more into business administration, but there are a lot of regulatory issues that arise. And the bigger the company, the more regulatory issues you're going to have, and you're going to have people who do nothing but compliance, do nothing but fill out paperwork and dealing with reporting requirements, and dealing with inspectors coming in or investigators, and that's just kind of the way it is. The bigger you get, the more you're going to invite this sort of thing. So corporations do have this. If you're a sole proprietorship, I doubt you're going to have a lot of this, but corporations do sort of invite this, and that's an issue. And by the way, if you're a public company, that is, you sell your shares to the public, then you've got regulators at the federal and in many cases also state levels who are looking at what you're doing, and they're also scrutinizing your financial statements, which is why if you're a public company, you have to hire a CPA firm to do the audit of your financial statements, and that's expensive, and it's just kind of the way it is. But that's an element of cost that does not apply to smaller businesses. So there are advantages. This is one disadvantage. The other is the idea of double taxation, and there's the idea that corporations are a separate legal entity, so they pay tax on the earnings of the company, and then whatever they distribute to owners, if they distribute anything to owners, in the form of dividends primarily, those are also taxed. And so as a result, you have this idea of double taxation. Okay. Now, sometimes companies do not pay dividends, and there are a lot of companies that don't pay dividends, particularly in the technology area. Companies are growing quickly and really don't pay much of a dividend at all. I mean, I think Microsoft didn't pay a dividend for years and years and years after they became public, and neither did Apple. And I don't think Apple still pays much of one. But people are okay with that because the fact the stock price keeps growing, because the company's reinvesting earnings and not distributing them in terms of dividends. And by the way, if you own a stock, if you're an outside investor, you own stock, and it goes up and up and up and up, you don't pay any taxes as the thing grows. Only until you sell do you pay tax. And so people like Warren Buffett, who've owned stocks for decades, have never paid taxes on a lot of their wealth because it's gone up and up and up. Income, yes, they do pay tax on, but not the actual amount. But double taxation. Now, I will say that double taxation, I think a lot of times there are a lot of people who are really against this idea of double taxation. I do have to say, I think that you really can't have it both ways. You have a separate legal identity of the company, so as a result, you shield investors from unlimited liability. They're limited to liability of their own investment. So the company's a legal entity in its own right. And by the way, a lot of companies don't pay dividends anyway, so the issue of double taxation is mostly moot in that situation as well. But if to the extent that they do, that does exist. And so it's been a debate that's been going on forever, as long as I've been an adult. We've talked about double taxation, but that is one disadvantage to the extent that it exists. Now, there are, and I don't want to spend a lot of time on this, but you can do what we call a subchapter S corporation, where there is no double taxation because the company itself is simply what we call a pass-through entity, like a partnership that simply passes all the earnings to owners. And so there's only one tax being paid, and that's by owners. But the problem there is the fact that they don't pay tax on retained earnings, they pay tax on everything. And as a result, they do end up paying the tax. And by the way, the corporate tax rate has come down. It used to be at a maximum of like 37%. I think when I was in graduate school, I think it was up to like 40%. And I think I've heard over time it's been a very, very high rate. Today, the corporate tax rate is 21%, which, by the way, is a lot lower than what a lot of individuals pay, like 37% for individual taxes. So as a result, this idea of the sub-S corporations being some sort of tax shelter may or may not be the case. And I know there was an issue where we tried to sort of resolve this, or Congress did. And again, I don't want to sort of get into the tax weeds here, but I do think it's important for us to sort of examine these issues, because double taxation has been a real criticism of sub-S of C corporations for a very long time. So I think it's something that we need to really talk about. Okay. Also, we have different types of corporations, nonprofits. That is, the corporation set up just to do nonprofit activities, whatever the case might be. And you will look to IRS Code Section 501, which has all kinds of different 501c2, 3, 4, maybe 501c3 is being the most common of these, but it's 501c3, C4, and it goes on and on and on. We have different, they're set up as corporations so that individual entities, investors do not have liability, but they're operating now for a for-profit basis. And so as a result, they're tax exempt entities. Churches is a big one, or any kind of religious organization, churches, synagogues, mosques, whatever the case might be. They have to get approval as that in order to become tax exempt. Also, any kind of government entity itself. So I presume CNN, I don't know what CNN's 501 status is. I guess I should know this, probably don't. But we're tax exempt because we're a public entity. We're owned by the state of New Mexico. And so as a result, a lot of these corporations, whether they're public or private, public is where anybody in the public can own it, but privately held is a little bit different. In this case, though, when I say public, what I was really referring to is government owned and whatnot. But these are non-profit entities, and so there's no taxation of these. And sometimes they start. And by the way, this last line here, sometimes companies start as privately owned corporations and then go public. And we say frequently, we're talking about this is the natural progression. The company starts. Now, I would prefer this be on a different page, because we're sort of talking about nonprofits here, and if we go to for-profit, Facebook or Meta, which is their corporate name, is definitely a for-profit company. But a lot of companies will start life as a proprietorship. You know, Amazon started in Bezos's dad's garage, right? Apple in someone else's garage. I think, I don't know, garage. Startups and whatnot. So, and then they get bigger and bigger, and they issue shares to the public and whatnot. So, but they started out as some entity that is not a corporation, typically, certainly not a publicly traded corporation. And as they get bigger, then they go public and they issue shares to the public. Okay. All right. And then one final thing here is about some hybrid organizations, and that is something it's fairly recent in corporate organization. The LLC has become very, very extremely popular. It's extremely easy to operate. I've set up a number of LLCs. They're easy peasy. They're done with the state. And by the way, corporations themselves are registered with individual states, not with the federal government. But LLCs are very easy to set up. Owners are known as members, and you can have an unlimited number of members. And there's going to be one member who's going to be sort of registered with the state where paperwork arrives at that person's address. But it's what we call a pass-through entity. It has the best of both worlds in a lot of ways, which is why LLCs are so popular right now. It shields individual owners from liabilities of the company itself. So if the company does something that's really egregious and it creates liability, it doesn't pass to the owners themselves individually, which is good. So yeah, that's one advantage that is a corporate type advantage that applies to individual members. But you avoid the double taxation issue because all the LLC is really doing is distributing earnings back to individual owners. And LLCs are set up by the state, and you can be taxed as corporations or whatever, but it doesn't really matter because the LLC pays no tax. There is no LLC tax return. There is simply a pass-through that goes to individual entities themselves. And so it's a pretty good system, and it's very popular. And I would suspect a lot of companies, and these are some of these are big companies too. These are not small at all. These are not individual companies doing drywall hanging. Not that there's anything wrong with that, but we're talking about big companies a lot of times taking advantage of the LLC nature. In limited liability partnerships, this is a little bit less common. I think what is more common in partnerships are what we call publicly traded partnerships, which have the element of LLCs and or limited liability, and that is the idea. And we see this happening with particularly, I think the movie business set up a lot of these different what we call syndicates of partnerships. We invest for a limited time, and it would sort of dissolve at some point. But we definitely see it here in New Mexico. We see a lot of oil and gas drilling, oil and gas pipelines that are partnerships that are publicly traded, and they have the same characteristics of this, but they're not corporations themselves. And so, as a result, what's good is you avoid the double taxation issue. The company pays no tax at all. It's set up as a partnership, and so, like all partnerships, all the taxes paid by individual owners, and they simply pass through on what we call a K-1 form, and then there's no big deal. And so as a result, there's an advantage to that particular structure. That's what we call a hybrid. It's got the advantages of the corporate shield of owners from what would be otherwise unlimited liability, and also the avoidance of the double taxation issue. Now we're talking about the Model Business Corporation Act. I don't want to talk a lot about this because it's interesting, and I've studied this a lot. When we talk about model acts, we're talking about model acts that are created and that are sort of recreated state to state to state typically. Now, one thing about corporate law is the idea it's done on a statewide basis. You don't register with a federal government, you do with the state government. So if you want to start a corporation, you'll go with whatever state you want to go to. Delaware has long been a destination for companies to incorporate because of the lower costs and the fact that the courts are very much familiar with corporate law there. So a lot of companies have nothing to do with Delaware whatsoever, will incorporate there. But when we talk about a model act, we're talking about some act that has sort of replicated itself across state lines and to the point where companies will adopt it. Now, there have been some criticisms of this, and I know the last job I had before I went back into academia, I was in the mortgage business, and there was one model act that was copied in the state of Georgia, which became law in New Mexico. And unfortunately, our legislators did not bother to read the print, and so they passed a law that said in the state of Georgia, whether, and they didn't bother to change the name Georgia to New Mexico. And so they go back and fix that at some point. So you get the idea, and your text gets into this idea of some of the criticisms of these model acts. The insurance business, New York state law tends to be the model act, which a lot of states have adopted. Insurance has typically been regulated at the state level. Most of the regulation otherwise has been, whether it's health insurance, there's federal regulation, or when it comes to things like tax, it's a federal issue, but primarily it's a state regulated issue. And so what we're really talking about is the idea that the Model Business Corporation Act is something that's been adopted by a lot of states. In fact, New Mexico adopted it in the 1960s, and it simply sort of lays out what the terms are of this. And I don't mean to stress the criticisms of model acts. I'm simply trying to lay out for you the idea that model acts have been around for a long time. It's not just restricted to this. When it comes to the MBCA, we're talking about something which a lot of states have adopted. We certainly did here in New Mexico. I think we amended it, I think it was 67 here in New Mexico we adopted. I think we amended it in 69 You can check my facts, somebody can check my math. I'm not a lawyer, so but I know that we've adopted this, and it sort of lays out what the method is, the methodology for incorporating a company, and it's kind of good because I think standardization is good. I think that one of the difficulties with different states is they have different patchwork of laws, and so it becomes sort of difficult to know what's going on where and whatnot. And I'm a big fan of uniformity, particularly when it's logically construed and makes it easier to do business. And I think it's all to the good. So the MBCA is something that's been around. It's an act that was adopted by individual states. The federal government can't necessarily make states adopt certain laws, but states will obviously do that from time to time. Okay, we talk about share rights. All right, so shifting gears here. So what are the issues? And again, we're sort of talking about what are the rights, obligations, and privileges of being a shareholder. So when we talk about common shares, where does the term common come from? Now, one thing I want to, I know I talked about this in Principles 1, but I want to sort of just burst the bubble just in case you're, thinking otherwise. Common does not imply the minor leagues and preferred is the major leagues. In other words, common is not the Isotopes and preferred are the Yankees necessarily. That's not really what it means. Common simply means all shareholders have the same rights and to everything, voting rights, dividend rights, everything else, and so they are lumped together in common. What preferred deals with is this idea of dividend payment, depending upon how the structure of the issue was set up. And we'll talk about this with regard to preferred dividends, whether cumulative, non-cumulative, whatever. We'll get that in a second. So what common shares really is the fact every common shareholder, every share they own is the same as every other person's share. Now, there are different classes of shares, and this is what makes it a little bit more complicated. You may have common share class A, class B, whatever. But nonetheless, within that same class, at least, everyone is all the same. So, the same voting rights, the same dividend rights, everything else, including the right to vote. If there's a right to vote, with common shares, there typically is, right? And then the dividends and whatnot. And in a distribution of assets, this is one that is talked about a little bit less, but if the company dissolves for whatever reason, then everyone is in common in terms of how they receive payout. If the company is dissolved through bankruptcy or liquidation or whatever, and common shareholders typically are sort of at the bottom of the list. Really, it's just kind of the way it is, and so we'll sort of talk about this issue of the hierarchy of who's to be paid. Usually, common shareholders are sort of the bottom line. And when I say bottom line, I mean we're definitely short of preferred shareholders, all bondholders, and even things like wage earners who have not been paid out, things like wages and benefits and all that. And when we talk about preemptive right, we're talking about this idea that, which is not as common, I think, today, and because some companies are so big, but it's this idea that company issues new shares. If there's a preemptive right, common shareholders can have the right right of first refusal, if you want to say, to buy more shares so they don't liquidate or dilute their share ownership. Most investors, and your text talks about this, and it's very, I definitely agree with it. Most shareholders do not really care about their percentage of ownership, unless you're a big investor, hedge fund, ETF, private equity, Warren Buffett type interest. Yeah, you probably don't want your interest to be diluted because you have board seats and whatnot. But if you're an individual investor, or even a pension fund or insurance company or a bank investing in the preemptive right is not that big of a deal. The idea of dilution, because what it simply means is if you issue 100,000 more shares, then your interest is going to go down simply as a percentage of ownership because your number of shares is not going to go up, right? It's going to dilute in percentage terms. But the preemptive right is an anti-dilution provision, which really doesn't apply in most cases. Okay, so we're talking about different classes of shares. I alluded to this a second ago. We have particularly common shares, but also preferred shares as well. You have different classes of stock, and Google is one that is sort of interesting because they've got different classes of common. Sometimes they refer only to original owners that own one class of stock and one they're class A, class B, whatever, and they have different dividend rates. and all that. And so they just have different rights. And so they're set up at different points in time. It's probably reasonable to assume that Class A was issued before Class B at some point in time. Also, preferred stock, whether it's preferred stock A, stock B, whatever, are issued at different times. And in the case of preferred stock, which really looks a lot like bonds, really, in my opinion, they have different rates that are paid out to investors on a routine basis. And so the shares of preferred can also be a different class. Stock, which are usually alphabetically organized, A, B, C, or whatever. And common preferred, well, some combination. We see a lot of preferred stock with the financial companies, and a lot of financial companies which are preferred stock. Preferred stock is really this hybrid stock where you really have no voting rights, but you do get a dividend that's more or less guaranteed that the company is liquid and whatnot, and it's paying you out. And so which really resembles more of a bond in the fact that there's a rate specified at the time of issue and whatnot. So as a result, preferred stock looks a little bit more like that. Let's talk about preferred. We're almost out of time, but I do want to talk about preferred before we leave. When we talk about preferred shares, we're talking about certain rights. Number one, if the board declares dividends, preferred shareholders will receive any dividend or any dividends paid to common shareholders. Always, always, always. And that's what is meant by preferred. Preferred does not necessarily mean these are a higher class. This is not the major leagues in terms of preferred versus the minor leagues in common. That's not what it means. In fact, a lot of investors prefer common to preferred because common shares have the opportunity to grow in value over time. Preferred stock, not so much. Preferred stock is really sort of a hybrid. It kind of bridges the difference between debt and equity. The advantage to investors, though, is the idea that the dividends that are received are taxed at the dividend tax rate, which is sometimes significantly lower than the ordinary income rate you would pay, like on interest from bonds, for instance. And so, in a lot of ways, preferred shareholders benefit in that regard. If they don't care about stock growth and price, retirees, I think probably a good element that would be interested in this, that sort of thing. So, also, they have a preference over common shareholders as a distribution of assets. And in the event the corporation is dissolved, this is the idea of the hierarchy within what we call the capital stack. And that is, there's a hierarchy of who gets paid out first if the company goes bust. And again, bankruptcy, and I'm not a lawyer, so I can't speak with great authority on bankruptcy, but bankruptcy does not always entail liquidation. Usually, in fact, I would say in the majority of cases, a Chapter 11 bankruptcy of a corporation simply is a reorganization where debt holders simply agree to some sort of new plan for repayment and whatnot. It doesn't mean the company goes bust. Chapter 7, I believe, is more of a liquidation where the company is simply not going to make it for whatever reason, and therefore whatever's left over after paying all creditors and also employees, right? Employees have rights as well. It's going to go to preferred shareholders first, but they're further down the list than bondholders because bondholders have a preferential role or a preferential right in the hierarchy of distribution. But in our discussion here, it's preferred versus common, and preferred shareholders are going to be preferred over common shareholders. And it's often the case when a company goes completely bankrupt, whether or not they liquidate or not. I'm thinking about GM in, I think it was 2008. General Motors went bankrupt. We own General Motors, they make Chevys and GMC trucks and whatnot. They went bankrupt. Their stock went to zero, and their common shareholders got nothing, as far as I know. Right? They were just totally wiped out. That's the way it is, right? The company was bankrupt, and they just had no choice, right? Even after government help and whatnot, they still went bankrupt. So, but there's a hierarchy in terms of repayment, and I don't honestly know what happened to preferred shareholders or whether even were preferred shareholders in this case. But I do know that a lot of all common shareholders, their interest went to zero. They were wiped out, and that happens. So it really has to do with the hierarchy of where one stands in what we call the capital stack. Debt holders have a preferential right over any equity holders. And within equity holders itself, preferred shareholders come before common shareholders. Okay. All right. So, any questions before we wrap it up? I think we got to get out of this room here. So, when we come back, we'll talk about this idea of other rights to preferred shareholders, like conversion and privilege, and we'll be talking about convertibles and whatnot. Those are shares that can be converted to common. We'll get to that on Thursday, and we'll talk more about that. And if you have any questions in the meantime, feel free to get with me. But we'll pick the rest of this up on Thursday and hopefully get through the majority of it. When I don't get done, hopefully I'll be able to introduce in a supplementary video. Okay. All right. Have a great rest of your day, and I will see you next time.